What I'm seeing is, so June, CPI was the 50th month in a row that inflation was above the Fed's asinine 2% target. So stable money is not 0%. In their world, it's 2%. And the way they count inflation is now 2.7% on the headline, 2.9% on the core. And both those figures year over year accelerated from the prior month. So in what world should we ever have a Federal Reserve that wants to cut interest rates? But we have one. The FOMC said they're thinking about cutting rates 1, maybe 2 times this year. And we have a president who, by the way, I voted for, who wants the Fed funds rate to be 1% right now, which would be about a 300 basis point immediate reduction in the overnight interbank lending rate. So I was shocked. I thought that was a very weird take that inflation is better than expected. My assertion is that inflation has wiped out the middle class of the country. My contention is that when you have 60% of the population with less than $1,000 of net worth, that's a huge problem. Inflation has destroyed them. They can't afford a house. So they can't afford really the basic necessities of life, food, clothing, shelter. They have no hopes of a comfortable retirement. And we're talking about cutting interest rates and sending asset prices, and the rich get richer and the poor get poorer. That's what's going to happen. I mean, you think home prices would go down, at least initially? I mean, what are we talking about here when the Fed slashes interest rates to 1%? Their hope is to bring interest rates down across the yield curve. I think that's not going to happen, by the way. I think they're in for a shock. But I think it's a huge mistake. Inflation is destroying this country, and it's putting a big cap on how fast GDP growth can accelerate. By the way, what do you think it would do to the US dollar, which is already on life support? They want to cut interest rates by 300 basis points. This the administration does. But the last time the Fed cuts interest rates 100 basis points in 2024. And what happened to the long end of the yield curve? It went higher. So, and the reason for me is clear. When you have an insolvency issue, when you have an inflation issue that you have not dealt with appropriately, why are you cutting interest rates? Now, home prices going up 20% year after year. And now we have a situation where we have a triumvirate of bubbles where you have equities in a magnificent bubble. And we can go through some metrics real quick. Total market cap of equities as a percentage of GDP is 210%. It's an all-time record high. The mean ratio is closer to 90 to 100%. The market cap of equities is over 2 times the size of the economy. That's a very unusual statistic. You have the CAPE ratio at 37.8, and when it's that high, the ensuing 10 years have never provided for a real return on investments. This is the second highest CAPE ratio ever. You look at the price to sales of stocks, they're trading at 3 times sales. And you look at something called the earnings yield. So risk premiums are negative. In other words, you could buy a T-bill and get 4.3, 4.4% on a T-bill, short duration US Treasury, and that earns you more than the earnings yield of stocks, which is the inverse of the PE ratio. So there's a lot of risk out there. And where did this come from? Why do we have a triumvirate of bubbles? Why do we have an equity bubble, a real estate bubble, and a credit bubble? And the reason is from 2002 to 2022, for the vast majority of that duration, we had negative real interest rates, a negative real Fed funds rate. That has never before happened in history. The only time that comes even close to that was the 5 years from, I think it was 74 to 79, which engendered the stagflation of the 70s and the massive unemployment and recession that we saw in the early 80s. So what's the playbook from the Federal Reserve? When we have a recession or we have a air pocket in stocks, temporary freeze of the credit markets, the Fed lowers interest rates to 0%. They engage in ZIRP, zero interest rate policies. They engage in QE. Lately, from this last COVID crisis, we had something called helicopter money, which was basically circumventing the banking system. So using the banking system as a direct conduit to monetize treasury debt. That's wonderful. That works from 1981 to really 2020. The big salient issue with this country was supposedly that we had a problem with deflation. And we were wringing our hands. How do we possibly get inflation going again? How can we possibly get the CPI to be 2%? Because the economy doesn't function normally or function well at all at 1.9% CPI. It's got to be 2, right? So they end up doing is they circumvented the banking system pretty much and used it as a direct conduit to monetize treasury debt. We got inflation at 20%. That's what happened. And that's the way they measure it. But I think really the inflation was higher than that. I mean, genuine inflation, they measured it at 9 something, but genuine inflation was higher than 20% in reality from many private sources. So now the cat's out of the bag. I mean, people now understand what's going to happen. So inflation has destroyed the middle class. We talked about that. Inflation has been higher than the Fed's target for 50 months. And if we go down the same playbook again, what's going to happen is that the long end of the bond market will revolt. And when you have the long end of the bond market revolt and interest rates spike there, what kind of debt is attached to the 10-year note? Let's see. It's mortgage debt. It's corporate debt. It's student loan debt. It's auto loan debt. In other words, the economy is going to tank precisely because of what the Fed is doing. So no matter what they do, if they do nothing, we fall into a deflationary collapse. If they actually follow the same playbook that they've done for decades now, you could cause a sovereign debt crisis. That's the danger. And it's a real danger because, as I mentioned, the Fed already tried it in 2024 and the bond market said, not going to tolerate it. Let's go back to April 2nd. On April 2nd, Trump announced his Liberation Day level of tariffs. And what happened was the S&P 500 dropped 15% in just a handful of trading days. And the credit markets began to freeze. And the reason why they froze, and let me just be very clear that normally when credit markets freeze, treasury prices climb and yields drop because people seek the safety of treasuries. But this time around, what I spoke about before happened, where the treasury yields spiked along with falling stocks and a dropping dollar. That's not usually what happens. And this is what I believe was happening, is that the level of tariffs were so onerous that it gave the impression that international trade would cease, which is most likely would have been the case. So if our creditor nations didn't have the excess dollars to recirculate into our treasury market, then we would have less buyers for sovereign debt. And all that meant was that, hey, if I'm a hedge fund that's leveraged 100 to 1 on, borrowing money to pick up, tiny little basis points on treasuries, I had to sell that because the bank told me unwind that trade quickly. So it caused a complete chaos in the treasury complex. That is a possible trigger for me. I mean, it's always a trigger as a recession and a freezing of the credit markets. And when it happens again, the response is going to cause a revolt in the credit markets to the point where I think bond yields spike. And that would cause my model. My model is going to pick up on that. I have a 20-point model called the inflation-deflation economic cycle model. So if you look at credit spreads and it looks at financial conditions, copper-gold ratio, it looks like the 10-2 treasury spreads. It looks at things like the 5-year break-even spread. So the model is built to pick up on what I call the cohort of oligarchs and despots that actually run the planet. So you think about the multi-billionaires, the heads of state, Putin, Trump, the head of the EU, but people who run billions in dollars, who get the phone call like Trump, they know Scott Bessent. And Scott Bessent tells them, hey, I know we just threatened 30% tariffs on Canada and Mexico, but the president's not going to follow through with that. This is just a bargaining chip. This is my way of legally trading that insider information, which is what Wall Street operates on. That's what, people surprises me. And I've been in the business for 35 years. People say that the Wall Street, the stocks knew, the market knows, this enigmatic force understand. No, it's not that. It's the multi-billionaires that are trading on insider information. They knew in 2007 that mortgage-backed securities and CDOs and CLOs that were collapsing and the real estate market was going to falter. The insiders did, not the talking heads on CNBC, not the writers for Yahoo Finance. Those are the people who began taking steps. And you can see their traces in the financial conditions index. And you can see the traces of that in the credit spreads, which is what my model picks up on. So right now I have about 10%, 15% of the portfolio in inflation hedges. That includes platinum. It's been there for a few months, gold for a much longer period of time. And I have an oil and gas ETF that is supposed to give me a hedge against inflation. Also has some gold miners in there. So I have 15% of the portfolio hedged for inflation. And inflation is accelerating on a first derivative and a second derivative basis. And I think in the end, that's where we're headed for. We're headed for stagflation. I think there could be a truncated period of deflation and recession/depression in there, but I'm very much concerned about what this country's response will be, which will lead us to stagflation like we could never before imagine in this country. That's what I'm really concerned about. I have, given the fact that the equity risk premium is negative, so there's just no reason to overweight stocks. I have 68 of the portfolio in T-bills. I have a very small short position. I have 10% US equities, 5% foreign stocks. That's the composite of portfolio. Working very well for us. It's a very low risk portfolio. I absolutely think platinum has a long way to go. Platinum is more rare than gold. And I'm old enough to remember for a very long time, platinum was more expensive than gold. That has flip-flop. So platinum has a long way to go, but it actually has a pretty big industrial component to it as well, which could hurt it too. I understand that it has the same kind of properties as silver, a little less volatile than silver though, which is why I like it. So given its historical relationship to gold and given its physical properties, I took a small position in platinum. I'm very happy for me and my clients that I did. Of course, that will have to be sold if we enter into that truncated recession/depression, deflationary air pocket, which I think is coming. It's just not now. So I'll just enjoy the ride up.